16 of 21 series are aligned with an expansion-strong environment this morning. That is a high but not extreme level of agreement across the framework's macro map. The current macro regime is expansion-strong, with a confirmation score of 16 out of 21. In this configuration, the macro regime label expansion-strong means the growth composite is mathematically accelerating, while the inflation composite is mathematically decelerating at the same time. Growth momentum is scored at XL, around plus 0.09 on the framework's normalized scale, signaling that activity indicators such as the Atlanta Federal Reserve's GDP tracker have strengthened over the past 2 sessions. Inflation momentum is scored at DCL, around minus 0.01, capturing a subtle but consistent slowing in the rate of change in price measures rather than outright deflation. The coherence score is strong, reflecting that the majority of the 21 series are moving in a way that fits this regime definition. And the confirmation score of 16 out of 21 indicates substantial alignment across rates, growth, inflation, and volatility series. By our historical reconstruction, regimes with a confirmation score in this range have persisted in roughly 61% of comparable 3-month windows, with the most frequently observed next state being a shift toward an acceleration regime, a characterization of past behavior only. Compared to last week, the framework's reading shows growth momentum firmer and confirmation nudging higher as more series slipped into expansion-consistent patterns. Historically, environments like this have coincided with steadier credit conditions, leadership rotating toward growth and cyclicals, and gold underperforming cash and risk assets, all recorded as how markets behaved in similar past setups, not as a roadmap. Let's walk through 4 signals inside that map, starting with Treasury yields. The 10-year Treasury yield sits near 4.70%, above the roughly 4.25% level of the 2-year, leaving a positive curve slope of about 0.43 percentage points. The framework tags this as green momentum when the curve is steepening by more than a statistically defined threshold over recent sessions, meaning longer-term rates are rising relative to shorter-term ones. Markets watch this because the shape of the curve is a long-standing barometer of growth expectations and funding conditions. The question it raises for allocators is whether a steeper curve changes how much duration risk or cyclical exposure they're comfortable carrying. In our framework's reading of comparable periods, this roughly coincided with calmer high-yield credit spreads and better relative performance from economically sensitive sectors within 1 to 3 months. A record of past behavior, not a forecast. What would challenge this read is a rapid reflattening or inversion, with the 2-year moving back above the 10-year. Labor conditions are the second signal, captured by non-farm payrolls and related employment series. Recent data have slowed enough for the framework to mark labor momentum closer to neutral, leaning red in some instances when payroll growth falls back toward or below trend, and the smoothed rate of change turns negative. Markets care because hiring is the backbone of household income and corporate confidence. The question for risk takers is whether softer hiring math challenges existing pricing for consumer-sensitive assets. In our framework's reading of comparable periods, this roughly coincided with more uneven equity performance and elevated volatility over the following 1 to 2 quarters, a record of past behavior, not a forecast. A clear challenge to this read would be a renewed acceleration in payroll growth and a sustained drop in the unemployment rate. Credit is the third signal, observed through high-yield credit spreads. The extra-yield investors demand to hold riskier corporate bonds. The framework currently flags spreads with red momentum when that extra yield widens by more than a defined threshold over a rolling window, indicating that lenders are demanding more compensation for risk. Markets follow this because credit spreads are a real-time stress gauge for corporate balance sheets and refinancing conditions. The question it raises is whether changing spreads alter how much leverage or credit exposure institutions are comfortable holding. In our framework's reading of comparable periods, this roughly coincided with periods where equity markets chopped sideways and defensive sectors gained relative strength over weeks to months. a record of past behavior under the methodology, not a forecast. What would challenge this signal is a sustained narrowing of spreads back toward prior lows. The fourth signal sits in equity sector behavior. The technology sector index is up about 4.98%, with industrials and materials also advancing, while traditionally defensive areas such as utilities and real estate are softer. The framework tags technology and cyclical sectors with green momentum, when price structure and rate of change both show persistent, above-threshold strength. Markets care because sector leadership often illustrates how investors are balancing growth narratives against defensiveness. The question is whether this pattern of leadership aligns or conflicts with each reader's own tolerance for cyclicality, valuation risk, and concentration. In our framework's reading of comparable periods, this roughly coincided with stronger participation in broader indexes and quieter credit conditions over the subsequent weeks, a record of past sector behavior, not a forecast. A challenge to that read would be a rotation back into defensives and a cooling of technology's relative strength. The conditional map turns those signals into if-then observations. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions. In our framework's reading, faster inflation momentum appeared in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. In regime context, that type of move has previously coincided with expansion phases transitioning into acceleration states in the math, not in forward guidance. If the Fear and Greed Sentiment Index drops below 15 and holds for 5 sessions, in our framework's reading, the confirmation score deteriorated in roughly 7 of 9 similar instances, a historical characterization, not a forecast. In prior records, that kind of extreme fear coincided with more fragile regime alignment. The map is live. These conditions are being monitored daily across all 21 series. The Given engine is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework. Price structure, rate of change, risk regime, and market participation across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, the engine records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside the engine. They are separate outputs. The regime does not pick the symbols. The 4 layers do. Members use the engine to study how the framework has recorded conditions across prior environments as historical behavior, not as trade selection. The Given engine runs the framework. You study the outputs and environment. You decide what to do next. The Given engine monitors all 21 series and all 407 symbols every trading morning, independently of regime, and those readings carry potential, and educational weight only. They are inputs for thinking, not instructions. Every trading day, this is free. Watch real symbols go active in live markets at the price it's happening, see which sectors are leading, and learn to read what's driving it yourself. That live view is the observation desk, the same 21 series and 407 symbols founding members study each morning, the environment underneath every move. If you want to watch it alongside us, the live view is at givenanalytics.com. Free to try, no credit card, for the first 500 founding members. Watch it before you risk $1. You decide.